You know, when a business makes a sale, it's not always as simple as cash changing hands. Sometimes it's just a promise, a kind of handshake deal that says, hey, I'll pay you later. So today, we're going to unpack the entire story behind those promises. And this isn't just dry accounting. It's really about the trust, the risk, and the strategy all wrapped up in a company's IOUs, which we call accounts receivable.
Okay, let's really think about this for a second. A company books $1 million in sales. That sounds great, right? But here's the kicker. How much of that is actually cash sitting in the bank versus how much is just, well, waiting to be collected? This very question is why understanding and managing accounts receivable is so absolutely critical for any business.
All right, so let's start at square one. What exactly is this promise we keep talking about? So, at its most basic, accounts receivable, or just AR for short, is the money that customers owe a business for things they bought on credit. The easiest way to think about it is this. The company did its part, they delivered the goods or the service, and now they're holding an IOU from their customer. And believe it or not, that IOU is actually considered an asset for the company. And you can see this for yourself right on a company's balance sheet. But notice something really important here. Companies don't just list the grand total of their IOUs. They have to be realistic. They show you the total, sure, but then they subtract something called an allowance for credit losses. What's left is the net amount, and that net number is their most honest guess at the cash they'll actually get their hands on. And that just begs the question, right? If a business knows for a fact that some customers just aren't going to pay up, how do they deal with that? How do they figure out what all those promises are truly worth? Well, that brings us to the next chapter in our story, taking a precaution. Because smart companies always plan for the fact that some promises are going to be broken.
The tool they use for this is called the allowance for credit losses. Now, it's technically a contra-asset account, which is just a fancy way of saying it's an asset with a negative balance that reduces your regular AR. But honestly, the best way to think of it is as a financial cushion. The company estimates how many sales will go bad and sets that amount aside to absorb the future losses.
And when you take that financial cushion, that allowance, and subtract it from the total IOUs, what you're left with is called the net realizable value, or NRV. This is the number that really matters. It's the most transparent, realistic picture of the cash the company truly expects to bring in. Now look, this isn't just some good idea a company might have. It's a core accounting rule, under what's called Generally Accepted Accounting Principles, or GAAP, which are basically the rules of the road for accounting in the US. Companies have to use this allowance method. Why? It's all about something called the matching principle. It makes sure that the expense from a bad sale is recorded in the very same period as the revenue from that sale, which gives you a much truer picture of how profitable the company was. Okay, so we get it. We need this financial cushion. But how big does it need to be? This brings us to the part that's both an art and a science, the prediction. How do companies actually go about estimating their future losses? Okay, so method number one is the really straightforward one. It's called the income statement approach. With this, a company just looks at its total credit sales for a period and says, all right, based on history, we know about, say, 2% of these sales are going to go bad. So they just take 2% of their credit sales and boom, that's their credit loss expense for the period. Let's walk through this example. Midberg Co. had $500,000 in credit sales, and they figured 2% won't be collected. The math here is super simple. $500,000 times 2% is a $10,000 credit loss expense. That $10,000 then gets added to whatever's already in their allowance cushion, bringing the new total up to $12,000. It's a quick, top-down way to do things. All right, now for the second method. And this is the one you'll probably see a lot more often. It's the balance sheet approach. And this one kind of flips the whole logic on its head. Instead of starting with the sales, it starts with the pile of IOUs you have left at the end of the period, your ending accounts receivable. The whole goal is to figure out what the final allowance cushion should be. Okay, so let's look at this new approach. The company has $100,000 in receivables at the end of the year and thinks 6% of that is uncollectible. That means their target for that allowance cushion is $6,000. Now here's the key. Let's say their cushion already has $2,000 in it from before. Well, they only need to add another $4,000 to hit their $6,000 target, right? So that $4,000 becomes their credit loss expense for the period. The expense is just the plug figure you need to get the allowance account to the right number. But you know what? We can do even better. We can get way more precise than just a flat percentage. Because, let's be real, not all IOUs are created equal. An IOU that's 90 days late is a heck of a lot riskier than one that's only 10 days late. And that's where something called an aging schedule comes into play.
So here's how it works, and it's actually pretty brilliant. First up, as you can see right here, the company sorts all its receivables into these age buckets. You can see that most of it, 71,000 out of the 100 grand, is current, meaning less than 30 days old. But way at the other end, there's $1,000 that's over 90 days past due.
And here's where the magic really happens. The company applies a different risk percentage to each of those buckets. They expect only 2% of the newest debts to go bad, but they're bracing for a 20% loss on those really old ones. So when you do the math for each bucket and add it all up, you get a much, much more precise target for that allowance cushion, $5,280. This is the kind of detail that shows you management really has a solid grip on who owes them money. All right, so we've covered the promise, the precaution, and the prediction. Now it's time for the outcome. What actually happens when it's time to either collect the cash or give up?
Sooner or later, a company just has to face facts and give up on collecting a specific IOU. That's called a write-off. When this happens, they remove that customer's balance from the gross AR, and they take the exact same amount out of their allowance cushion. Okay, and here is the absolute key takeaway. The write-off itself, it doesn't change the net AR on the balance sheet one bit, and it definitely doesn't hit that period's expenses. Why? Because you already accounted for it. You did the work up front when you built that allowance.
Okay, but what if a company is in a jam and they need cash like right now? They can't just wait around for customers to pay. Well, they have an escape hatch. It's called factoring. This is where they literally sell their IOUs, their receivables, to another company called a factor. It's a move that could signal they're in a cash crunch, or it could just be a smart, strategic decision to let someone else handle collections. This example really lays out the trade-off, doesn't it? The company submits $100,000 in receivables. After the factor takes out a reserve, a fee, and some interest, the company walks away with about $85,000 in cash, right now. They get less than the full amount, sure, but they get it immediately, and they don't have to chase anyone for the money. So if you're an analyst, you have to ask, is this company struggling for cash, or are they just being efficient and outsourcing their collections?
Okay, let's zoom out and pull all these pieces together. Let's look at the full story, from beginning to end.
This slide just lays it all out perfectly. On the left, you've got the life cycle of the gross accounts receivable account. It starts with a balance, goes up with new credit sales, and comes down as cash comes in or accounts get written off. And on the right, you've got its partner, the allowance account. It starts with its own balance, goes up with new expense estimates, and comes down when those write-offs actually happen. See how they work together? They're in perfect sync.
So when you boil it all down, accounts receivable is so much more than just a number on a page, isn't it? It's this whole dynamic story of trust, risk, and ultimately, cash. How a company handles these IOUs, how well it predicts its losses, how fast it collects its money, and when it decides to sell them off, that tells you a massive amount about its discipline and its overall financial health. It really is a story about the promises a company makes, and more importantly, the promises it keeps.